L&T has reported its quarter four numbers, and it's reported a steady set of numbers coming for the fourth quarter. The company has reported a revenue, EBITDA and margin in line with what we were expecting, whereas the PAT has come in slightly higher than the analyst expectations. L&T also reported FY24 order inflow higher than 3 lakh crores, up over 31% on a year-on-year basis. Well, R. Shankar Raman, CFO L&T, is talking right now. Let's quickly go and cut across the presser.
Chip Design Venture, a separate subsidiary company, was incorporated in December to take this initiative forward. The company also in its business portfolio completed the restructuring of its financial services business through merger of various entities undertaking that business into a single retail lending digitally enabled platform. As a next step towards divestment of non-core businesses, the company completed its divestment of toll roads and transmission line concession business through the sale of its stake in L&T IDPL. Last but not the least, the company successfully completed its leadership transition with Mr. S. N. Subramaniam, taking over the chairmanship of the company from Mr. Nayak. As I get down to discuss the financial performance of the company, let me make my usual disclaimer about forward-looking statements, if any, made during the course of this session. Things can change in the course of the year, and to that extent, we have to modify our assessment of the situation and the business conditions as we go forward. But at the moment, looking back at FY24, in more specific terms, as I mentioned, the company has achieved robust all-round growth during FY24. The order inflow that the company has achieved is about 3 trillion rupees, 3.02 trillion rupees, which is a hefty 31% growth over the previous year. Consequent to this strong order inflow, the order book of the company rises by 20% to 4.75 trillion rupees. The revenue earned by the company in FY24 is 2.21 trillion rupees, which is a 21% growth over the 18.3 trillion that we had 2.2 trillion over 1.8 trillion that we reported in FY23. The EBITDA margins of the company for FY24 is at 10.6%, 70 basis points lower than the 11.3% of the previous year. However, the recurring profit after tax at 130 billion rupees is up 25% as compared to 104 billion rupees of the previous year. And the recurring profits, when inclusive of the exceptional gain of 1 billion rupees that we have earned on the divestment of IDPL, the overall profit after tax at 131 billion rupees is 25% higher than the 105 billion rupees of the previous year. All these numbers that I called out are consolidated numbers for the company. The net working capital of the company improved remarkably to 12% of the revenue, down from 16% 1 year ago. This is a significant change in the complexion of capital employed of the company. Given the overall increase in profit after tax by 25% and lesser resource deployed by the company, the return on equity of the company increased to 14.9% as compared to 12.2% of the previous year. As you might remember, we have a ROE target of about 18% by FY26. And when we started this 5-year journey, we were at about 9%. We have climbed our way up to close to 15% as at end FY24. And with 2 more years to go, our pursuit of the 18% ROE continues. Looking at the performance of the company for FY24, the board was pleased to recommend to the shareholders a dividend of ₹28 per share for FY24. And this was against ₹24 per share that was announced for the previous year, a growth of about 16%. Just to refresh your mind, in the middle of the year FY24, the company had also declared a special dividend of rupees 6 per equity share to coincide with the stepping down of Mr. A.M. Nayak from the chairmanship of the company. Now moving over to the order inflow, which is the principal lever on which the company's revenues, cash flows and profits flow from. During Q4, that is January-March 24 quarter, the company won orders worth 721 billion rupees, which comprises of 469 billion rupees of domestic orders and 252 billion rupees of international orders. Roughly 65% of this 721 billion came from domestic orders. In a way, a departure from the past trend of the earlier quarters, where the international orders for the quarter was outpacing the domestic orders. The domestic orders essentially came from sectors such as transportation infrastructure, particularly the high-speed rail corridor, our precision engineering and systems business, and the hydrocarbon business for its domestic operations. The domestic orders for quarter 4 grew by about 17% as compared to the previous year's quarter 4. The previous year, quarter 4, we had domestic orders of 401 billion rupees out of the total of 761 billion, and that has increased to 469 billion rupees out of the total of 721 billion. Looking at the year as a whole, the company won orders worth 3.02 trillion rupees, which is a 31% growth over the 2.3 trillion that we reported for FY23. 54% of the 3.02 trillion rupees is from international orders, and the international orders actually grew by 89% as compared to the international orders that we won in FY23. The growth in the international business is largely led by the order wins we have had in the solar business and also in the normal power transmission distribution business and in the hydrocarbon business. Out of this order inflow of international business, 70% of the orders are from Middle Eastern markets. Our business actually is dependent on the investment that is being made in the economy, and to that extent the investment environment has been pretty conducive in FY24. We expect the tailwinds of this investment momentum to continue in FY25 as well. Looking at our order book has grown by 20% from 3.9 trillion rupees as of March 23 to 4.75 trillion in March 24. For a growth achieved on such a large base is indeed commendable. As far as the order book of 4.75 trillion rupees is concerned, nearly 65% of that order book is from infrastructure segment and about 25% is from energy segment. The rest of the businesses account for the balance. Nearly 38% of the order book of 4.75 trillion is from international contracts. That is to say, about 1.8 trillion rupees is from international contracts out of the 4.75 trillion of the overall order book. Moving on to segment information, we are looking at infrastructure segment to start with, and the investment momentum has been pretty brisk in the infrastructure segment. Usually the ordering activity peaks in H2, and more particularly in Q4 on any financial year. The FY24 was a little different actually. While the first 6 to 9 months was brisk, ordering slowed down in Q4, and this was in a way anticipated due to the election-related interruptions that was expected in India particularly. The order inflow of the infrastructure segment is about 313 billion rupees for quarter 4, and about 1.4 trillion rupees for the year as a whole. The 1.42 trillion rupees of order inflow for the year for infrastructure segment is nearly 22% higher than the order inflow we reported in the previous year. 38% of the orders that we won in the in the infrastructure project business belong to the international markets. The net segment revenue earned by the infrastructure segment is 380 billion rupees for quarter 4, which is close to 22% higher than the revenue of Q4 of the previous year. And for the year as a whole, it is at 1.12 trillion rupees, which is 30% higher than the 867 billion rupees of the previous year. So both in terms of order intake as well as execution, the company in the infrastructure segment has performed pretty well. The EBITDA margin of the infrastructure segment is at 6.2%, lower by 80 basis points as compared to the 7%. The decline in margin largely arises from the time delay in execution of projects, particularly in the area of infrastructure projects, and also delayed settlement of the cost claims. We've been speaking about cost inflation, and we've been speaking about a portion of those will get reimbursed by the client as we complete those projects. So the time lag between incurring the cost and accounting the cost, deflating the margins as compared to recovery of these in the subsequent periods, will play out in any given quarter. And to that extent, the impact of such situations are also visible in the FY24 results that we are publishing. Also, the investment that the company is making for its growth in the infrastructure business segment, due to the large order wins during FY24 and over 3 trillion rupees order backlog or order book that the segment has, would also mean some amount of spending out of the margins earned for beefing up the execution capability of the company. So a combination of cost inflation, time overrun, delayed settlement of claims, and investment for growth really accounts for the decline that we see in the margins of the infrastructure segment and hence the margins in the company overall. Looking at the prospect, the pipeline for infra segment appears very encouraging for FY25. With the improvement in execution schedule and productivity improvement measures, the margins are expected to get better as we move forward. Moving on to the next segment, which is energy segment. The energy segment comprises of both hydrocarbon business and power business. And the investment conditions in the hydrocarbon segment, particularly in Middle East, have been robust. The company is done well to take advantage of this environment by staying technically and financially competitive and improving its order wins of the opportunities it has targeted. In contrast to the hydrocarbon segment, the prospects for coal-based power plants have been very limited, and these are largely in Indian context. And while we cannot really rule out coal as a source of fuel asset, the company is focusing more on oil and gas and green energy. So consequently, the dominance of hydrocarbons business and green energy business in the energy project segments would continue even going forward. Hence, much of the numbers that I'm going to call out for the energy project segment relate to the hydrocarbon business. The order inflow of the company for the quarter 4 of FY24 is 131 billion rupees, which is 48% higher than the order inflow reported in the previous year, quarter 4. And for the full year, the company is reporting 737 billion rupees of fresh orders, which is over 100% of the 307 billion that we reported 1 year ago. Nearly 90% of the total orders are from international markets, and that can be explained by just the sheer scale and size of international orders in the context of the domestic orders that we tend to win. The net segment revenue from the energy project segment is 82 billion rupees for quarter 4 and 295 billion rupees for the full year FY24. The full year revenue of 295 billion is higher by 19% as compared to the revenue it earned 1 year ago. Like in the case of order inflow, nearly 58% of the revenue earned by this energy project segment is arising out of the international contracts that we are executing. Not only has this business done well, both in terms of order inflow and in terms of revenue growth, it has also done well on the margin front. The EBITDA margin has increased from 9.1% of the previous year to 10% in the current year FY24. The growth in revenue and margin are reflective of the efficient execution of the large order book that this segment has. This segment has over 1 trillion rupees worth of orders to be executed. And going forward, we do expect the robustness in terms of execution and margins to continue. However, given the geopolitical developments, military escalation in West Asia, etc., the growth in the order inflow for FY25 needs to be carefully watched. In the current year that we are reporting for FY24, we are reporting more than 100% growth in order inflow for the energy project segment. It may not be a sustainable number because the bases have changed and the conditions have also changed. So we possibly could report in FY25 a relatively lesser, stronger number in terms of order inflow. However, the revenue and the margins are expected to stay strong as we continue to execute the large order book that we have. Moving over to the manufacturing segment, the manufacturing segment comprises of both the heavy engineering business that we run and the precision engineering systems business. The precision engineering and systems business, what erstwhile we used to call it as defense. While the heavy engineering business caters to largely process industries like petrochemical, fertilizers, etc., and also to the nuclear power industry, the precision engineering system sector business caters to defense and aerospace sectors. The order inflow of this segment for Q4 FY24 is 88 billion rupees, and for the full year it is 142 billion rupees. The segment revenue for this quarter 4 FY24, Jan-March FY24 is 24.6 billion rupees, 15% higher than the revenue of the previous year's quarter 4. And for the full year at 82 billion rupees, it is a good 25% higher than the revenue we reported in the previous year. The EBITDA margins continues to remain healthy around 16.3% for this business. Getting on to our services part of business portfolio, the first up is IT and technology services segment. And this is a combination of two listed subsidiaries that we have, as you know, both LTI Mindtree as well as L&T Technology Services. And you would have possibly had an opportunity to see the results that these companies have disclosed to the stock exchange and media and the investing world a few weeks ago. But in the context of our consolidated numbers, the IT business and the technology business is an important and a strategic component, and hence I will spend a couple of minutes on this. The IT business actually is witnessing, as you might have read from reports of many of the companies operating in this segment, sectorial headwinds. The market conditions have not been very conducive. It's been challenging, and hence there's been rising competition among players for the shrunk opportunity. However, the opportunity size is expected to vary depending on the dynamics of this sector. At the moment, there has been some deferral of discretionary spends, and we do expect the investment in technology not really to slow down, and that companies such as our subsidiaries will increasingly find their way around these current headwinds and get into stronger growth mode as compared to what has happened in FY24. FY24, the companies together reported a revenue of 112 billion rupees in quarter 4, which is a 3% growth year on year. And for the full year, it reported 444 billion rupees, which is a 7% growth year on year. If you recall, the yearly growths were well into double digits in the past couple of years, and to that extent, there is a break from that trajectory. Bulk of this revenue anyway is from international markets, essentially US, UK, Europe, and the rest of the world. The EBITDA margins continues to stay healthy at about 20%, even though there are cost pressures in terms of talent, investment in new technology, talent retention, etc. The company continues to, the segment continues to find opportunities to offer its services in a profitable manner. Moving on to the financial services segment, which is another important element in our services business portfolio. The performance of the FS business was also announced to the markets sometime a week or so ago, and you, like in the case of IT companies, could have possibly had a look at it.